Fundamentals of Auditing Chapter 0 Chapter. Meaning of audit. An audit is an independent examination of financial information of any entity, whether or not profit oriented, and irrespective of its size and legal form. When such an examination is conducted with a view to express an opinion thereon. Objective of the audit or auditor: to express an opinion, audit report, on financial statements, whether the financial statements are free from material misstatements and whether they are prepared as per applicable financial reporting framework. Auditor. Auditor is used to refer the person or persons conducting the audit, usually engagement partner or other members of the engagement team or the firm. When it comes to acceptance of responsibility or being accountable to regulatory authorities, then engagement partner shall only be referred as auditor. Practically, the meaning of the auditor includes the following persons: engagement team, engagement partner, audit manager, paid assistant, senior article assistant, junior article assistant, any other designation. Books of accounts. As per Companies Act 2013, books of accounts as defined in Section 2, Subsection 13 includes records maintained in respect of all sums of money received and expended by a company and matters in relation to which their receipts and expenditure take place. All sales and purchases of goods and services by the company, the assets and liabilities of the company, and the items of cost as may be prescribed under Section 148. Financial statements. Definition as per SA 200: a structured representation of historical financial information, including related notes, intended to communicate an entity's economic resources or obligations at a point in time or the changes therein for the period of time in accordance with applicable financial reporting framework. The related notes ordinarily comprise a summary of significant accounting policies and other explanatory information. Definition as per Companies Act. Financial statements includes the following: balance sheet, profit and loss account or income and expenditure account, cash flow statement, statement of changes in equity if applicable, any explanatory notes annexed to or forming part of financial statements. Users of the financial statements. Management purpose: for day-to-day decision making and performance evaluation. Proprietor or shareholders: to analyze performance, profitability and financial position. Note: prospective investors are interested in the track record of the company. Lenders: banks and financial institutions, to determine the financial position and strength of the company, debt service coverage, etc. Suppliers: to determine the creditworthiness of the company. Customers: to know the general business viability before entering into long-term contracts and arrangement. Government: to ensure prompt collection of direct and indirect tax revenues, to evaluate performance and contribution to social objectives. Research scholars: for study, research and analysis purpose. Employees: job security, bonus. Applicable financial reporting framework. In view of nature of the entity and the objective of financial statements, the framework adopted by the management for preparation and presentation of financial statements is known as applicable financial reporting framework. In other words, a financial reporting framework is nothing but a set of rules and regulations that are to be followed for preparation and presentation of financial statements. For example, the applicable financial reporting framework is Schedule 3 and accounting standards for a company. General purpose financial statements. If the financial statements are prepared in accordance with general purpose framework, then they are called general purpose financial statements. Special purpose financial statements. If financial statements prepared in accordance with a special purpose framework, in other words, if financial statements are prepared as per the requirement of specific user, then they are known as special purpose financial statements. General purpose framework. A financial reporting framework designed to meet the common financial information needs of wide range of users. Framework may be understood as rules and regulations. Characteristics of general purpose framework. Fundamental accounting assumptions are used in this type of framework. Compliance with GAAP as in generally accepted accounting principles, accounting standards as per applicable financial reporting framework, annual preparation periodically. Further, this financial reporting framework may be a compliance framework or fair presentation framework. Compliance framework. It refers to a framework where financial statements are prepared and presented in accordance with the requirements of such framework without any deviation. The words true and fair view do not appear in the financial statements in this type of framework. Example, most of special purpose financial statements are prepared as per compliance framework. Fair presentation framework. It refers to a framework where financial statements are prepared and presented in accordance with the requirements of such framework. Contains disclosures beyond the requirements of such framework explicitly or implicitly, or may deviate from the requirement of the framework so as to achieve the presentation explicitly. The words true and fair view appears only in this type of framework. Example, most of general purpose financial statements are prepared as per fair presentation framework. Legal form. There are several types of legal form in which people ordinarily conduct businesses. This is similar to person definition under Income Tax Act. The following are the various types of legal forms: proprietorship form, partnership form, limited liability partnership, society, company, AOP or BOI, and any other artificial juridical person. Misstatement. A difference between the amount classification, presentation or disclosure of a reported financial statement item and the amount classification, presentation or disclosure that is required as per applicable financial reporting framework. Misstatements can arise from error or fraud, an intentional act by one or more individuals among management, those charged with governance, employees or third parties, involving the use of deception to obtain unjust or illegal advantage. Fraudulent financial reporting. It involves intentional misstatements, including omissions of amounts or disclosures in financial statements to deceive the financial statement users, either overstatement or understatement of performance position. Misappropriation of assets. Involves theft of an entity assets and is often perpetrated by employees in relatively small and immaterial amounts. Also, it involved misuse of resources. Error. The term error refers to unintentional mistakes in financial statements such as clerical errors like errors of omission, errors of commission, errors of duplication and compensating errors. Misapplication of accounting policies called error of principle. From point of view of audit, these errors are two types, namely self-revealing errors, apparent on record and easily identifiable, and non-self-revealing errors, non-apparent and require additional efforts to detect them.